A Random Walk Down Wall Street by Burton G. Malkiel. This book is a comprehensive guide to investing that explains the intricacies of financial markets, while making a strong case for passive, long-term investment strategies. First published in 1973, the book has been regularly updated and remains highly influential in the world of finance. Malkiel advocates for the random walk theory, which suggests that stock prices move unpredictably, making it nearly impossible to consistently outperform the market through active management. Below is a summary of the key ideas from the book. Introduction. What is a random walk? Malkiel introduces the concept of the random walk. In financial markets, a random walk implies that future movements of stock prices are unpredictable and not influenced by past trends or patterns. This idea directly challenges the notion that expert investors or financial analysts can consistently beat the market by picking stocks or timing the market. According to Malkiel, stock prices are driven by new information, and since news arrives randomly, stock prices should also change in an unpredictable, random fashion. Efficient Market Hypothesis, EMH. A central theme of the book is the efficient market hypothesis, EMH, which suggests that financial markets are highly efficient in processing information. According to EMH, stock prices already reflect all publicly available information, and any new information is quickly incorporated into stock prices. This means that no investor has a systematic advantage over others because everyone has access to the same information. Malkiel divides the efficient market hypothesis into three forms. 1. Weak form efficiency. This form suggests that past stock prices and volume data are already reflected in current stock prices. Therefore, technical analysis, using historical price charts and trading volumes to predict future price movements, is ineffective. 2. Semi-strong form efficiency. This form asserts that all publicly available information, including financial statements and news reports, is reflected in stock prices. Consequently, fundamental analysis, evaluating a company's financial health, is unlikely to yield consistently superior returns. 3. Strong form efficiency. This form posits that even insider information is quickly incorporated into stock prices, meaning that no one can consistently achieve higher returns, not even those with access to private company information. While Malkiel acknowledges that markets are not perfectly efficient, and there may be occasional anomalies, he argues that they are efficient enough to make it nearly impossible for investors to consistently outperform the market. The case against active management. Malkiel critiques active investment strategies, such as stock picking and market timing, which are commonly used by mutual fund managers and professional investors. He presents compelling evidence showing that most actively managed funds fail to outperform market indices over the long term. Malkiel attributes this to several factors. High fees. Active management usually comes with higher fees due to the cost of research, trading, and management. These fees eat into investor returns, making it harder for active funds to outperform. Transaction costs. Active managers often trade more frequently, which leads to higher transaction costs that reduce overall returns. Human biases. Malkiel argues that even professional investors are subject to cognitive biases, such as overconfidence and herd behavior, which often lead to poor investment decisions. He backs up his claims with numerous studies showing that, over the long term, low-cost index funds outperform the majority of actively managed mutual funds. The crux of Malkiel's argument is that trying to beat the market through active strategies is a fool's errand, and most investors would be better off simply buying and holding a broad market index. The role of technical and fundamental analysis. Malkiel explores the two main schools of thought in stock analysis: technical analysis and fundamental analysis. 1. Technical analysis. Technical analysts believe that historical price movements and trading volumes can be used to predict future stock price movements. They rely on price charts and patterns, using past data to make predictions about where prices will go next. Malkiel is highly critical of technical analysis. arguing that stock prices follow a random walk, making past price patterns irrelevant for predicting future movements. He presents research showing that technical strategies often fail to deliver consistent returns, as they rely on outdated or irrelevant information. 2. Fundamental analysis. Fundamental analysts, on the other hand, evaluate a company's financial health by analyzing earnings, dividends, management, and competitive advantages. They aim to determine the intrinsic value of a stock and buy it if the market price is below this value. While Malkiel acknowledges that fundamental analysis can sometimes identify undervalued stocks, he argues that it is difficult to consistently outperform the market using this method. Many professional analysts use similar data and methods, making it hard for any one investor to gain a lasting advantage. Furthermore, new information is quickly incorporated into stock prices, making it difficult to find true bargains in an efficient market. Modern portfolio theory and asset allocation. Malkiel introduces modern portfolio theory (MPT), which focuses on diversification to reduce risk. The theory, developed by Harry Malkiel, suggests that by holding a variety of assets that are not perfectly correlated, i.e., do not move in the same direction at the same time, investors can reduce the overall volatility of their portfolios without sacrificing returns. The key takeaway from MPT is that investors should not focus on individual stocks, but rather on how their entire portfolio is constructed. By diversifying across different asset classes, stocks, bonds, real estate, and international investments, investors can reduce risk and improve the stability of their returns. Malkiel also emphasizes the importance of asset allocation, which refers to how an investor divides their portfolio among different asset categories, such as stocks, bonds, and cash. He advises that the right asset allocation depends on an individual's risk tolerance, investment horizon, and financial goals. Younger investors can typically afford to take on more risk by allocating a larger portion of their portfolios to stocks, while older investors should shift towards safer assets, like bonds, as they approach retirement. Behavioral finance and market bubbles. Malkiel acknowledges that markets are not perfectly efficient, and that there are occasional anomalies and bubbles caused by human behavior. He introduces the field of behavioral finance, which studies how psychological factors influence investors and financial markets. Common cognitive biases include overconfidence. Investors often overestimate their ability to predict market movements, leading to excessive trading and poor returns. Herd behavior. Many investors follow the crowd, buying stocks during market booms and selling during busts, which exacerbates market volatility. Loss aversion. Investors tend to fear losses more than they value gains, leading to irrational decisions, such as holding on to losing investments in the hope of breaking even. Malkiel discusses several famous market bubbles, including the Dutch tulip mania of the 1600s, the dot-com bubble of the late 1990s, and the housing bubble of the mid-2000s. These bubbles are driven by irrational exuberance, where investors bid up asset prices far beyond their intrinsic value, only for the bubble to burst and prices to crash. The case for index funds. The core recommendation of the book is for investors to embrace passive investing through low-cost index funds. An index fund is a type of mutual fund or exchange-traded fund, ETF, that aims to replicate the performance of a specific market index, such as the S&P 500. Since index funds are passively managed, they have much lower fees than actively managed funds. Malkiel argues that index funds offer several advantages. Diversification. By investing in an index fund, you automatically gain exposure to a broad range of stocks, reducing the risk associated with individual companies. Low costs. Index funds typically have much lower management fees and transaction costs than actively managed funds. Superior long-term performance. Historically, index funds have outperformed the majority of actively managed funds over the long term. He encourages investors to build a diversified portfolio of index funds, covering different asset classes, such as US stocks, international stocks, and bonds, and to hold on to these investments for the long term. Conclusion: the random walk to financial success. In the final chapters, Malkiel reiterates that the best way to achieve financial success is to adopt a passive, long-term investment strategy. He advises against trying to time the market or pick individual stocks, as these strategies are unlikely to consistently outperform the market. Instead, he recommends investing in a diversified portfolio of low-cost index funds, maintaining a disciplined approach, and allowing compound interest to work its magic over time. Malkiel's random walk theory and advocacy for index funds have revolutionized the way many people think about investing. His central message is that anyone can build wealth by following a simple, disciplined strategy, one that doesn't rely on outsmarting the market but instead on taking advantage of its long-term growth.